Hi everyone, this is Jimmy. I'm a CALMAT student, and this presentation is for the business class 552, and also this is my final assignment for the page 652 and 653 CP12-4. Okay, let's get started. First of all, before I can answer the questions, we have to know what is the definition of market value method and equity method. So for the first one, market value method, it basically reports securities at their current market value. So it's very clear. It's current market value. Okay. So for the second one, equity method means usually is used when an investor can exert significant influence over an investee. The method permits recording the investor's share of the investee's income. So it's kind of confused. What is the significant influence? So I will give the clear understanding in the next slide. So in here, investment in the securities of other companies. So you can see this chart. I have like passive for the debt securities from the left, and the middle one, when the company they have less than 20% of investment on their outstanding stock, is also categorized in the passive. Okay, and next one, see this one is kind of bigger, like investment is about 20 to 50% of outstanding stock. Between 20 to 50% of the investment, this range we usually call significant influence. So remember, 20% to 50%. Any number within this range we call significant influence. So for the bottom one, large than 50% of outstanding stock is called control. So when you want to control the company, or you want to have a really design very important decision, you want to control the company's decision, then usually if you have more than 50% of their stock, then you are able to do that. Okay, so now we kind of understand what is the significant influence. So let's see that this is the questions. So it's kind of we have to analyze the financial effects of the market value and equity method. So I kind of just want to read these questions for you guys, so you guys know what I'm talking about. So on January 1st, 2008, Woodrow Company purchases 30% of the outstanding common stock of Trevor Corporation at a total cost of $560,000. Management intends to hold the stock for the long term. On the December 31st, 2008, the balance sheet, the investment in Travelers Corporation was $720,000, but there's no additional Travelers stock was purchased, and the company received $80,000 in cash divided from Travelers. The dividends was declared and paid during 2008. The company Woodrow used the equity method to account for its investment in Trevor. The market price of Trevor stock during 2008 to a total value of $600,000. Okay, so we have read this question, and then this is the question we have to answer. For the first one, explain why the investment account balance increased from $560,000 to $720,000 during 2008. Second question is, what amount of revenue from the investment was reported during 2008? The third question, if Woodrow did not have significant influence over Travers and used the market value method, what amount of revenue from investment should have been reported in 2008? And the last question, if Woodrow didn't have significant influence over Travers and used the market value method, what amount should be reported as the investment in Trevor Corporation in the December 31st, 2008 balance sheet? Okay, so we got 4 questions to answer. And now let's get started. So as you can see, I have listed out the formula and how I calculate these numbers. Okay, so for the first one, we know the Woodrow purchased 560,000 stock in cash. So we have 560,000 cash minus because they paid it. And then for the traveler, they sell the stock to Woodrow. So we also put 560,000 because they get money. So that's a plus A. Okay, and go to the bottom on December 31st, 2008 balance sheet. In here, we withdraw investment in Trevor stock for the 720,000, and also investment in Trevor stock cost 560,000 plus the share of investment in Trevor's earning, which is 160,000. And also they received 8,000 in cash divided from Traveler. In this case, entries. Woodrow received cash of Traveler's dividend is 80,000, and share of investee Traveler's dividend minus A also 80,000. So this is how we this is the answer for the first one. The difference from 560,000 to 720,000 because due to the incurred share of investees Trevor's earning in 2008, because because this one indicates there has been a plenty good investment years for Woodrow. It's about a 29% gain. So this number changed because they make money. The Travers company, the corporation, they make money. So that's from 560,000 to 720,000. Okay, this is the first one answer. And for the second one, the answer should be there won't have revenue from the investment be reported during 2008 because Woodrow is using equity method. So due to the 30% of ownership in Traveler, investor and investee share the same effects of gain or loss. Based on participate percentage ratio, they don't have to report the revenue. Okay, for the third one, the answer would be 80,000 for the declared dividend be reported as investment income revenue during 2008. So the 80,000 for the declared dividend be reported because if market value method is used and Woodrow doesn't have significant influence over the investee Traveler, so that's why 80,000 was declared. Okay. For the last one, this is the answer. If Woodrow didn't have significant influence over Trevor and used the market value method, what amount should be reported as the investment in Trevor Corporation in the December 31st, 2008 balance sheet? So we can see the total is 120,000. Okay, thank you for your time. Appreciate it. Thank you. Bye.